Welcome back to the deep dive. You've done the hard work, helped your client find that perfect property, navigated the disclosures, maybe even battled through a competitive offer situation, and then that amazing notification pops up. Offer accepted. That
Yes.
feeling is incredible, right? It feels like the finish line.
It absolutely does. But, for your client's investment and frankly for your reputation as a professional guide, the race has really just entered its most critical stage.
Hmm.
That accepted offer isn't the finish line. It's just the green flag on the legal grand finale. It's where the ownership baton is officially, legally, and irrevocably passed.
And getting this part right is everything. Because what happens between accepted offer and getting the keys? Well, it involves potential hidden risks, legal technicalities, and a whole lot of coordinated effort.
That's right.
Today, we're diving deep into the unsung heroes who make this handover happen securely. The deed, which is the undeniable proof of who owns what.
The proof. Yes.
Title insurance, your client's crucial shield against problems from the past.
The protection. Very important.
And escrow, the essential neutral referee that makes sure every I is dotted and T is crossed.
Mastering these components is non-negotiable. It's not just about passing the state exam, It's about truly understanding how to protect your client's massive investment and guide them confidently to a secure closing.
Right.
And as our sources highlight, it also means being aware of how this process interacts with financial and tax considerations that could impact your client.
Our mission in this deep dive is to pull out the most important knowledge nuggets specifically for you, the aspiring or current California real estate professional, from a stack of source material. We've been digging into IRS publications on property sales and exchanges, California-specific legal insights on deeds and title, and detailed information from California escrow associations and resources. We're going to make sense of it all.
Absolutely. Think of us as your guides navigating this final critical stage, ready to jump in.
Let's unpack this, starting with the foundational piece, the deed. This is the official legal baton pass.
Right. At its core, a deed is simply the legal instrument used to transfer title ownership of real property. It's the document signed by the current owner, the grantor, giving their ownership interest to the new owner, the grantee. It's the tangible legal proof of that handover. Without a properly executed and delivered deed, the transfer hasn't happened in the eyes of the law.
And the type of deed matters significantly, especially here in California. Our sources really highlight two key players.
They do. The most common deed you'll encounter in a standard sale is the grant deed. Now, a grant deed does more than just transfer interest. It carries with it certain implied promises or covenants from the grantor to the grantee.
Implied promises, like what?
Well, California Civil Code Section 1113, a reference in our source material, spells these out. Essentially two main things. First, the grantor implicitly promises that they haven't already conveyed the same property or any part of it or any interest in it to someone else prior to this transfer.
So no double dealing.
Exactly. And second, they promise that the property is free of any encumbrances that the grantor themselves placed upon it.
So if a seller took out a second mortgage last week that wasn't paid off, and they transfer using a grant deed, they've essentially breached an implied promise in that deed.
Precisely. It provides a layer of legal protection for the buyer against certain actions of the immediate seller. It's, a statement of confidence from the grantor about the state of the title as it relates to their own actions.
Okay, that's the grant deed. What about the other main type, the one that sounds a little less certain? The quitclaim deed.
The quitclaim deed. This one is fundamentally different. A quitclaim deed transfers only whatever present right, title, and interest the grantor has in the property at the very moment the deed is delivered.
Only whatever they have right then.
Right then. And here's the critical difference. It contains no warranties or covenants whatsoever.
No warranties. The grantor isn't even promising they actually have any interest to transfer. That sounds incredibly risky for a buyer. Why would anyone ever use one or accept one?
Great question, and that's exactly the point our sources underscore. A quitclaim deed doesn't imply any covenant regarding the quality of the title, freedom from encumbrances, or even the grantor's right to possess the property.
Nothing.
The phrase often used in these deeds, release, remise, and quitclaim, literally means the grantor is just giving up whatever claim or interest they might have.
So if the grantor has zero interest, the buyer gets zero interest, and they have no legal recourse based on the deed itself.
That's correct. The deed doesn't guarantee anything about the title's conditions, so why use them? Well, they are typically used in non-sale situations,
Okay.
often where the exact interest is uncertain, or the goal is simply to clear up potential claims or transfer interest between related parties. Think, transfers between spouses in a divorce to remove one name from title,
Oh.
transferring property into a trust, or clearing up a minor boundary dispute by having a neighbor quitclaim any potential interest. They are also used in certain involuntary transfers like tax sales or foreclosures.
Right, where the seller isn't the original owner.
Exactly. The transferring party, like a sheriff, only wants to convey whatever interest they legally possess at that moment, with absolutely no guarantees. The sources clarify that it's a valid legal instrument, even if the grantor doesn't have possession or a clear possessory right.
Okay, so understanding the type of deed is crucial. Grant deed for typical sales with some implied promises. Quit claim for transferring whatever interest exists with zero promises. Now, how do you actually fill out and record one? Our Sacramento County Force gives us a good roadmap here.
Yeah, this source from the Sacramento County Public Law Library is excellent for the practicalities. It lists the key pieces of information absolutely required on a new deed. First, you need the assessor's parcel number, APN.
APN, got it.
This is the unique identifier for the property used by the county for property tax purposes. You'll find it on the current deed.
Like the property's social security number for tax purposes.
Exactly. You also need the document transfer tax amount or the applicable exemption code. California counties levy a tax on property transfers.
Right, the transfer tax.
And the source mentions Sacramento County's rate is 1.1% of the current market value, though rates can vary slightly by locality. If the transfer is exempt, like a transfer between spouses or into a trust, you need to list the specific exemption code from the Revenue and Taxation Code.
And then, of course, the names. Crucial part.
Yes, the names of the grantor, the person or people signing away ownership, and the names of the grantees, the person or people receiving ownership.
Okay.
And it is absolutely critical that the grantor's name is spelled exactly as it appears on the deed by which they originally took title. Any variation can create a cloud on title.
Really, just a small typo.
It absolutely can cause problems down the line. And for the grantees, it's important to understand that once a name is listed as a grantee on the recorded deed, that person is a legal owner. You can't remove them later without their signature on a new deed.
That's a key point for clients to understand, especially in family situations. What about how the new owners will hold title? This is where things like tenants in common come in, right?
This is another crucial decision for the grantees, and the Sacramento County source provides clear guidance on how to phrase this on the deed. But it's vital to remind clients to consult legal counsel about the implications of each form for their specific situation, particularly regarding inheritance and control.
Absolutely. We're not giving legal advice here.
No, definitely not. So if it's a single unmarried owner, usually no specific form is needed. For multiple owners who are not married, tenants in common is a common choice. You'd list the names as tenants in common.
Okay.
What's key here is that ownership can be unequal, and if it is, you must specify the percentage or fraction for each owner right on the deed, like John Doe, a 50% interest, Jeffrey Doe, a 25% interest, and Paula Smith, a 25% interest as tenants in common. Each owner can sell or will their share independently.
And joint tenants, that one has different implications, right? The survivorship thing.
It does. Big difference. For joint tenants, you list the names simply as joint tenants. The defining characteristic here is the right of survivorship.
So,
if one joint tenant passes away, their interest automatically transfers to the surviving joint tenants without going through the probate process. All joint tenants must have equal ownership interests. That's key.
and for married couples or registered domestic partners in California.
The primary option is community property. You'd list their names as community property. This aligns with California's community property laws, where assets acquired during marriage are owned equally by both spouses.
Makes sense.
The source also covers how other entities take title, like trusts. You'd list as trustees of the trust name Living Trust. Or partnerships, corporations, LLCs, they all need their specific legal name and type on the deed.
Once all this information is correctly filled out, who needs to sign the deed? Just the seller.
The grantor, the current owner transferring title, are the ones who must sign the deed. And that signature needs to be acknowledged by a notary public.
A notary.
The notary verifies the identity of the signer and witnesses the signature. You can find notaries at banks, mailing services, title, and escrow companies.
Or mobile notaries, right? They can come to you.
Exactly. Mobile notaries are very common now.
Okay, so only the person giving the property away needs to sign and get it notarized. The new owners, the grantees, they don't sign the deed itself.
That's right. The grantees do not typically need to sign the deed. Their acceptance of the property is usually implied by, receiving the deed and taking ownership.
After the deed is signed and notarized, there's another piece of paperwork that goes with it, the PCOR.
Yes, a required form called the Preliminary Change of Ownership Report, or PCOR. PCOR. This form is filed with the county assessor whenever there's a change in ownership.
And why is that needed?
Its purpose is basically to notify the assessor's office of the transfer so they can update their tax records. This might trigger a reassessment for property tax purposes under Prop 13, unless an exemption applies.
Ah, okay. Tax implications.
Right. You file this form along with the deed at the county recorder's office. Each county has its own version, and the source points to Cal Assessor e-forms as a resource for finding the correct county form.
And the very last step in making this official, putting it on record.
Recording the deed. You take the completed, signed, and notarized deed, the filled-out PCOR, and the required transfer tax payment to the county recorder's office. Recording the deed serves as public notice of the transfer.
So everyone knows who the new owner is.
Exactly. Until a deed is recorded, while the transfer might be valid between the grantor and grantee, it doesn't provide official constructive notice to the rest of the world about the new owner. And that's crucial for protecting the buyer's interest against future claims.
That step of recording sounds essential for protecting the buyer's rights. Now, you mentioned a fascinating California-specific legal concept related to deeds. Let's put a CA corner spotlight on the after-acquired title doctrine. What's that about?
Yeah, this is a really powerful sort of quiet protection for buyers, particularly those receiving a grant deed. The doctrine, it's in the California Civil Code, Section 1106, addresses a specific situation. What happens if a seller transfers property using a grant deed, but at the time of that transfer, they didn't actually hold the complete or perfect title they purported to convey? Maybe they only owned a part, or there was some issue, a cloud on title they didn't know about.
Okay, so the seller thinks they own 100% and sells it with a grant deed, but later it turns out they only own 75% at the time of the sale? Like that?
Exactly like that. The after-acquired title doctrine says that if that seller later acquires the missing piece of title, maybe they inherit the other 25%, or they clear the cloud on title, that newly acquired title automatically passes to the buyer, the grantee, they previously sold the property to via the grant deed.
Wow. Automatically. No extra steps.
Automatically. The law basically says, hey, seller, you promised you're giving full title with that grant deed. You didn't quite have it then, but you do now. Great. It automatically goes to the buyer you initially transferred it to.
That's amazing. So it protects the buyer even after the fact.
Precisely. It perfects the buyer's title once the seller's title is perfected, even years later. It prevents the seller from benefiting from their initial incomplete transfer. It's a significant safeguard embedded in California law, showing the legal weight carried by those implied covenants in a grant deed.
That's a fantastic nugget of knowledge. It really highlights the depth of protection a simple grant deed can offer here in California. All right, so we've navigated the legal handover document, the deed, but simply having the deed doesn't guarantee a clear history of ownership. That's where our next unsung hero comes in, title insurance.
Absolutely. Real estate is a massive investment, and you need to know that the ownership you're receiving is solid, free from hidden problems that might surface years from now. That's the role of title insurance.
What is it exactly?
Our sources define it in California as a contract that insures, guarantees, or indemnifies owners and lenders against losses related to defects in the title, the validity and enforceability of liens, and accuracy issues arising from title searches.
Okay, so it's insurance for the title.
Mm-hmm.
How is that different from, say, homeowners insurance, which covers future events like a fire?
This is the key distinction, and one emphasized in the source material. Unlike most insurance, title insurance looks backward.
Backwards.
Yes. It protects against losses resulting from defects or issues that already existed in the history of the property's title before the policy was issued, but were unknown at the time of the sale. It covers risks from the past, not the future.
Okay, that makes sense.
And the policy remains in effect for as long as the insured party owns the property.
Problems from the past. What kind of hidden issues could title insurance protect against? Give me some examples.
Oh, the possibilities are surprisingly numerous. We're talking about things that should be in the public record but might have been missed or are incorrect, things like errors or omissions in previous deeds or public records, forged documents in the chain of title history, undisclosed or unknown liens from prior owners like old contractor liens, judgment liens, or unpaid taxes that attach to the
Wow.
property, undisclosed easements or boundary disputes, claims by previously unknown heirs of a deceased former owner, or even issues arising from improperly executed documents or mistakes in legal descriptions.
Any of those could be incredibly expensive and stressful to resolve. Yikes.
Exactly. And that's precisely why title insurance is crucial for peace of mind for a buyer. It protects them against the financial costs, both legal defense costs and potential losses in property value that could arise if one of these historical title defects is discovered after closing.
So it's really about securing that investment.
Absolutely. Securing it against unseen ghosts from the property's past.
Are there different types of policies?
Yes, typically two main types are involved in a residential transaction, as mentioned in the sources. The owner's policy protects the buyer, the new owner of the property.
Okay, owner protection.
And the lender's policy protects the lender who provided the mortgage financing. Lenders virtually always require a lender's policy to protect their security interest in the property up to the loan amount.
Makes sense. They want their loan secured.
Right. The rate manual source also mentions specific policy types like the CL Alta homeowner's policy, which offers enhanced coverage. And there are specialized products like a litigation guarantee for specific legal situations.
Before the policy is issued, the title company does a deep dive into the property's history, right? And they issue a report, the prelim.
Yes, that's the preliminary title report, often called the prelim. This is one of the key documents reviewed during the escrow process, as noted in our sources.
Okay.
After the title company conducts a thorough search of the public records related to the property's chain of title, they issue this report. The prelim shows the current status of title and lists any potential defects, liens, encumbrances, or exceptions that were found during their search.
So the prelim is like a sneak peek at potential problems before the final policy is issued. A heads up.
Exactly. It's a critical opportunity for the buyer and their agent to review what the title company found and understand anything that might affect the title. If something unexpected appears on the prelim, like that old easement we talked about or an unreleased lien, it needs to be investigated and usually cleared before closing. Items listed as exceptions on the prelim are things that the final title insurance policy will not cover.
Good to know. Now, a CA corner question that often comes up.
Mm-hmm.
Is owner's title insurance legally required for a buyer in California?
This is a common point of confusion. Our sources confirm that while a lender's policy is almost universally required by any lender providing financing,
Right.
an owner's title insurance policy is not legally mandated in California.
So a buyer could theoretically skip it, just roll the dice.
They could, yes.
Hmm.
But doing so would mean they are fully exposed to all the risks of those historical title defects we just discussed.
Doesn't sound wise.
No, not at all. The unanimous recommendation from professionals, and strongly implied by the sources, is that while not required by law, obtaining an owner's policy is a vital and prudent step for any buyer to protect their significant investment.
So as an agent, you should explain that clearly.
Absolutely. Explain the distinction and the risks involved if a buyer considers opting out. And reviewing the prelim carefully is crucial regardless of whether the owner's policy is purchased.
And of course, this protection comes at a cost. How does that work?
It does. Our sources, specifically the Title Insurance Rates and Rules Manual, give some insight. Fees are typically based on the purchase price or the loan amount, reflecting the liability the insurance company is taking on.
Okay.
The manual shows examples like a basic rate of, say, $450 for a transaction up to $100,000, increasing maybe to $1,600 for a $1.25 million cash sale. Transactions involving loans have additional fees, often a base fee plus extra charges for loan-related services.
As it scales.
It scales. And there are specific fees for things like binders or endorsements that modify policy coverage. These rate schedules provide a framework, but the final cost will depend on the specifics.
Okay, we've covered the deed, the legal document, and title insurance, the protection against past issues. But how do all these pieces working? The money, the documents, the conditions of the sale, the title clearance get managed and coordinated to ensure a smooth and legal closing. That's where escrow comes in.
Escrow is truly the central hub, the neutral conductor of the real estate transaction after the purchase agreement is signed. It's a process where all the funds, documents, and instructions necessary to complete the sale are deposited with a neutral third party, the escrow holder or escrow company.
A neutral third party.
Right. That third party holds everything safely until all the conditions of the purchase agreement and the escrow instructions have been met.
What exactly is the role of that neutral third party, the escrow officer? What do they do?
The escrow officer's role, as detailed in our sources, is to act impartially, following the written instructions provided by the buyer and seller. They facilitate the transfer of money, calculate and prorate taxes and other costs, prepare necessary closing documents like the closing statement, coordinate with the buyer's lender, receive and hold funds and documents, keep a detailed accounting of all money handled, and ultimately process the transaction until it's ready to close.
You keep emphasizing neutral. Why is that neutrality so fundamental to the escrow process?
It's absolutely essential because the escrow holder represents neither the buyer nor the seller. They are an agent of the principals to the transaction, tasked solely with executing the mutually agreed upon terms and instructions.
So they don't take sides.
Never. This impartiality is critical. As the DRE pamphlet source points out, an escrow officer does not negotiate the purchase contract or advise either the buyer or the seller on the terms or wisdom of the deal itself. They are administrators of the transaction, not advocates for any party.
That distinction is important. They aren't there to give advice or make judgment calls, just to follow the rules set by the contract. Are there different kinds of companies that can provide escrow services in California?
Yes, and this is an important distinction for agents to understand for their clients' protection. According to the DRE pamphlet, there are two main categories in California. First, licensed escrow companies.
Okay, licensed.
These are sometimes referred to as independent escrow companies. They are licensed and heavily regulated by the Department of Business Oversight, the DBO. They must meet specific, strict requirements regarding finances, bonding procedures, and they get regular audits.
So they're closely watched. What's the other type?
The other type are controlled escrow companies, or non-independent escrows. These companies are not licensed by the DBO.
Not licensed.
Not by the DBO. Instead, they are owned and operated by other entities that are licensed by different agencies, most commonly real estate brokers, licensed by the DRE, or title insurance companies, licensed by the Department of Insurance.
This feels like an important CA corner for regulation and due diligence. What should agents know about this difference? Why does it matter?
Well, this distinction is highlighted in the DRE pamphlet precisely because of the regulatory differences and consumer protection implications. For real estate brokers who offer escrow services and use a business name that includes escrow, California law actually requires them to clearly state that they are a non-independent broker escrow in all advertising.
Oh, interesting. So they have to disclose that.
Yes, it's meant to inform consumers that the escrow service is owned by the brokerage, not a separately licensed independent entity. It's about transparency regarding ownership.
Makes sense.
And the DRE pamphlet strongly advises everyone involved in a transaction, including agents guiding their clients, to check the license status and disciplinary record of the chosen escrow holder with their respective regulatory agency, whether it's the DBO, DRE, or Department of Insurance.
So do your homework on the escrow company.
Definitely. This due diligence is a crucial step to help prevent potential fraud or mismanagement of funds. Brokers who run these escrows are directly responsible for following trust fund laws and can face DRE discipline, so the oversight matters.
That's solid advice for protecting everyone involved. Let's walk through the key steps of the escrow process itself, drawing from the sources, detailing the flow. Where does it start?
The process officially begins with initiation once the purchase agreement is signed and fully executed. The contract and the initial deposit are typically opened with the chosen escrow holder.
Okay, escrow is open, then what?
A key step that follows is creating escrow instructions. The escrow officer gathers the terms of the sale from the purchase contract and other agreements and drafts formal, detailed escrow instructions.
So these are like the official marching orders for escrow.
Exactly. These instructions essentially tell the escrow holder exactly what they need to do, what documents to collect, what conditions must be met, and how funds should be dispersed. Both the buyer and seller must review and sign these instructions.
And they have to match the purchase contract, right?
Precisely. They formalize the contract's terms for the escrow holder. While these instructions are being drafted and signed, the escrow officer is busy on multiple fronts behind the scenes. They order necessary reports, like the prelim we discussed, any required inspections, like a termite report if the contract requires it, and HOA documents if applicable. They also work with the seller's existing lenders to obtain payoff demands for any loans that will be paid off at closing.
Getting all those documents and payoffs sounds like a lot of coordination. juggling act.
It is. Once they have the sign instructions and all the initial reports and demands, the source mentions a step called the pre-audit of the file.
Pre-audit.
Yeah. This is where the escrow officer reviews everything they've gathered, cross-referencing it with the instructions and the purchase contract. They coordinate with the agents, the title company, and the buyer's lender to ensure all necessary items and conditions for closing are being addressed and are, on track.
What are some of those implicit steps happening concurrently with instruction gathering in the pre-audit? What else is going on?
Well, based on how the process works and other sources, these include things like the buyer securing their final loan approval and the appraisal being completed, major steps often coordinated with the lender by the agent.
Right, the loan stuff.
And the buyer conducting physical inspections and reviewing disclosures, the buyer's lender preparing the final loan documents. Escrow coordinates the signing of these loan docs, which requires a notary, sometimes a mobile notary, travels to the buyer.
Okay.
Escrow also receives the funds needed for closing, the buyer's down payment and closing costs, usually wired, and the loan funds from the lender.
So they collect all the money and all the signed documents. They hold it all.
Exactly. They hold everything in escrow securely until the day of closing. Once all the conditions outlined in the escrow instructions are fully satisfied, loan funded, all documents signed and received, title is clear based on the final title rundown, buyer's funds are in, seller's payoffs are ready, then the escrow officer proceeds to the clause of escrow.
The big day.
Right. At closing, the deed transferring title to the buyer is sent to the county recorder for recording. The funds are dispersed according to the instructions, seller gets proceeds, old loans are paid off, closing costs are paid, and title officially transfers as of the moment the deed is recorded. The buyer gets the keys.
It sounds like a complex dance of coordination. What are the most common things that cause that dance to stumble, leading to delays or even cancellation? Where do things go wrong?
Our sources are pretty clear on this. Financing issues are by far the most frequent culprits.
The loan, again.
Yep. This includes the buyer failing to get final loan approval after being pre-approved, the property appraisal coming in too low to satisfy the lender's requirements, or the buyer simply not fulfilling all the lender's conditions or providing requested documents promptly. Any snag in the loan process can push back the closing date significantly.
Or kill the deal.
Or cause the deal to fall apart entirely. Yeah.
That makes sense. The financing contingency is usually the biggest hurdle late in the game. What else causes problems?
Missing required documents from either party can cause delays. This might be the seller not providing their full disclosure packet in time, a required termite clearance certificate not being received, or the buyer delaying in providing proof of funds for their down payment. Delays in scheduling and completing necessary inspections can also slow things down.
Inspections, okay.
Yeah, things like inspections for lead paint, asbestos, or hazardous materials, as mentioned regarding required disclosures, need to be done within the contractual timeframes. Prompt scheduling and communication around inspection results are key to staying on schedule.
And of course, there are fees for the escrow services, similar to title insurance.
Yes, escrow companies charge fees for their services, which are also based on rate schedules, much like title insurance. The rates can vary depending on the complexity of the transaction and the services required. The source material even included examples of how escrow fees scale with the sale price and whether a loan is involved. They also list additional fees for more complex situations, like short sales or construction loans, which require more involved procedures.
Okay, we've covered the deed, title insurance, and escrow in detail, the legal, the protection, and the process. Now let's put on our agent hats with our Think 11 Second, this agent segment. How do we use all this knowledge in real-world practice? Where does the rubber meet the road?
This is exactly it. Understanding these mechanisms isn't just academic. It directly informs how you advise and guide your clients. Let's run through a few scenarios based on our sources.
All right, scenario one, the disclosure dilemma, touching on our ethical compass. Your seller client casually mentions that years ago they had a significant plumbing leak, caused some water damage, but they had it fully repaired. They're not sure if they need to mention it since it was fixed. You know, California law requires disclosure of no material defects, even if repaired. How do you handle this ethically and effectively?
Okay, this is a classic test of an agent's integrity, right? Your knowledge of disclosure laws tells you this must be disclosed, period.
No gray area.
No. You explain to your seller client that California is a disclosure state, and the legal requirement is to disclose known material facts regardless of whether they've been repaired. You emphasize that failing to disclose can lead to significant legal trouble, later lawsuits, demands for repair costs, even rescission of the sale.
Serious consequences.
Very. So you guide them to complete the transfer disclosure statement, TDS, and any supplemental disclosure forms thoroughly and honestly. You tell them, specifically mention the past issue, the repair, and who did the work if you have that info, while you don't fill out the forms for them.
Right, you can't do that.
You advise and educate them on their legal obligations, ensuring you fulfill your duty to both parties and uphold ethical standards.
That's critical. Protecting your clients often means making sure they follow the rules, even if it feels inconvenient. Okay, scenario 2, title trouble. The preliminary title report comes back, and it shows an old recorded utility easement running across the back of the lot. Never mentioned by the seller, not visible. Your buyer client is planning to build a pool right where the easement is. How do you navigate this?
First, you recognize the prelim's purpose and flag this issue. You immediately review the easement details on the report. What utility does it benefit? What are the restrictions? Can you build over it? Can you plant on it?
Get the specifics.
Exactly. You work with the escrow officer and the title company to get a clear understanding of the easement's terms and implications. Then, you clearly explain the potential impact to your buyer client. You discuss how it might affect their plans for the pool.
So they understand the limitation.
Right. Depending on the severity and the client's needs, you might explore options with the title company or seller to see if the easement can be relocated or released, although that's often complex and maybe not feasible. But your knowledge of the prelim's role empowers you to spot this early and address it before closing becomes jeopardized.
Scenario 3, escrow expectations. Your buyer client is used to lightning-fast transactions, maybe from another state, and is getting impatient with this standard 30-day escrow period. They saw something online suggesting escrows should be faster. How do you manage their anxiety and set realistic expectations?
Yeah, this happens. You use your knowledge of the escrow process steps to educate and prepare them. You explain that escrow involves numerous moving parts: loan processing and underwriting, appraisal, inspections, title clearance, coordinating documents from multiple parties. It's not just one thing.
It takes time.
It takes time. You walk them through the typical timeline, explaining that certain steps, like the appraisal or final loan underwriting, have their own processes that take time and are out of your direct control sometimes. You emphasize the importance of responding immediately to any requests from their lender or the escrow officer,
Be responsive.
because delays on their end are the most common cause of holding things up. You also remind them, gently, that their lender or mortgage broker is the definitive source for updates specifically on the loan status, and you'll be in constant communication with everyone to keep things moving.
Good. Proactive communication is key. And scenario 4, deed. Details. You're representing a single buyer, but their elderly parent is contributing a large sum to the down payment and wants their name on the deed for safekeeping. How do you advise your client based on our sources?
Ooh, this situation requires careful handling. You lean on your knowledge of forms of title. You explain to your client the implications of adding another name to the deed. You clarify that listing the parent as a grantee makes them a legal owner, likely as tenants in common with the buyer. You explain what tenancy in common means: separate, potentially unequal shares, no automatic right of survivorship. Crucially, you explain that once on title, the parent's interest cannot be removed without their signature.
That's a big one.
Huge. And if the parent passes away, their share will go to their heirs via their will or probate, not automatically to the buyer, which could create complications later. So while you explain the options like adding them as tenants in common, or maybe exploring other ways the parent can secure their contribution that don't involve joint ownership, like a recorded lien if appropriate,
Right.
you absolutely do not tell them which option they should choose. You strongly advise them to consult with an attorney, specifically one specializing in real estate, estate planning, or family law, to understand the legal, financial, and inheritance implications and determine the best course for their specific family situation.
Excellent point. Always recommend legal counsel for those decisions. Those are great examples of how deeply intertwined this technical knowledge is with practical client guidance.
Absolutely. And thinking strategically like an agent also means recognizing that the transaction process connects to broader financial implications for your clients. This brings us to our Adapt and Connect segment, drawing from the IRS publications we reviewed.
Okay, taxes.
Right. While agents aren't tax advisors, understanding concepts like basis and capital gains helps you identify when your client needs to talk to one.
Tax concepts can feel intimidating, but what's the essential foundation an agent should be aware of? What's basis?
The absolute core is understanding basis. Generally, the basis of property is what you paid for it, the purchase price plus certain closing costs. But basis can be determined differently if property is acquired through gift or inheritance, as IRS Pub 551 explains.
And that initial basis can change over time, right? It's called adjusted basis.
Exactly. Your basis is adjusted upwards for certain costs you incur while owning the property. Think capital improvements, like adding a room or replacing a roof.
Things that add value.
Right. Also, amounts paid to repair property damage and special assessments for local improvements. But a key distinction Pub 523 makes is that costs for routine maintenance and minor repairs are generally not added to basis. Only significant improvements are.
Okay, and it can go down too.
It can be adjusted downwards for things like depreciation claimed, if the property was used for business or rental,
Ah, depreciation.
certain tax credits related to the property, or amounts received for granting an easement that reduce the property's value.
Okay, so adjusted basis is the starting point for calculating gain or loss when the property is sold.
Precisely. The gain or loss on the sale of property is generally calculated as the sale price minus your adjusted basis. And the sale price isn't just the cash received, it includes the fair market value of any other property received and the value of any notes or mortgages the buyer assumes.
And if the sale price is higher than the adjusted basis, you have a gain, which might be a capital gain. How does that work?
Oh, right. When you sell a capital asset like real estate for a profit, you have a capital gain. The tax treatment depends critically on how long you own the property. This is a short-term versus long-term distinction.
Okay.
If you own the property for 1 year or less, the gain is considered short-term. Short-term capital gains are taxed at your ordinary income tax rates, which can be significantly higher.
Like your regular job income tax rate.
Pretty much. Could be up to 37% depending on your bracket. But if you hold it longer,
More than a year.
if you own the property for more than 1 year, the gain is considered long-term. Long-term capital gains are taxed at lower, more favorable rates, typically 0%, 15%, or 20%, depending on your overall taxable income. This difference is a major factor for clients, especially investors.
Big difference. And sales generally need to be reported to the IRS.
Yes, unless the entire gain is excludable under a specific rule, like the main home sale exclusion, which has its own rules we aren't diving into today, the sale generally needs to be reported. Pub 523 mentions forms like 1099-S, 8949, and Schedule D might be involved.
Beyond a standard sale of a primary residence or simple investment property, are there special situations an agent should be aware of that trigger different tax treatments? Things to flag.
Absolutely, and these are the key adapt and connect points. For agents recognizing these situations flags the need for expert tax advice. Pub 523 details what happens if the property was used partly for business or rental.
Okay, like a home office or renting out a room.
Exactly. If a property was used as both a home and even a small part for business or rental activities, the tax treatment upon sale is affected.
How so?
Well, if the business or rental use was a portion within the home itself, like a qualifying home office, you generally don't have to allocate the sale price and basis between the home and business parts. However,
Always a however.
any depreciation you were allowed to claim on the business portion after May 6, 1997 must be recaptured upon sale and reported as ordinary income, taxed at potentially higher rates up to 25%.
Recaptured depreciation. Okay. What if the business or rental part is separate, like a duplex where you live in one unit and rent the other?
Good question. If the business or rental use is in a physically separate part of the property, like that duplex unit, or maybe a separate structure like a detached workshop used for business, then you must allocate the sale price and basis between the residential and non-residential parts.
Split the numbers.
Right. The gain on the non-residential part is reported separately, potentially on Form 4797, and it might not qualify for the main home sale exclusion unless specific use tests for that separate part are met. And Pub 523 notes that even if a property was formerly used for business or rental and then converted to a main home, the depreciation taken during the business use period after May 6, 1997 still needs to be recaptured as ordinary income upon sale, even if the gain qualifies for the main home exclusion. This allocation and recapture is a big one for agents to spot.
Okay, that definitely sounds like a call your CPA situation. What about exchanging properties instead of selling? The 1031 thing.
That brings in like-kind exchanges, or Section 131 exchanges covered in Pub 544. This is a major tax strategy for investors. It allows taxpayers to potentially postpone paying tax on capital gains if they exchange business or investment property for other like-kind business or investment property.
So I can swatch one rental property for another and avoid the tax bill immediately. Defer it.
That's the core concept. Postpone or defer the gain. The replacement property must be held for investment or productive use in a trade or business. Pub 523 specifically warns you cannot convert the replacement property into your main home immediately after the exchange.
Okay, has to stay investment.
Right. And there are strict rules about identifying potential replacement properties within 45 days and closing on them within 180 days. Very tight deadlines.
And there's something specific in there relevant to real estate agents acting as facilitators, right? Or warning.
Absolutely, and this is a critical adapt and connect point for you as an agent. Pub 544 explicitly states that when using a qualified intermediary or exchange facilitator to handle a deferred 1031 exchange, certain people who have acted as your agent within the 2-year period before the property transfer are considered disqualified persons.
Disqualified from what?
From acting as that qualified intermediary. This list includes employees, attorneys, accountants, and critically for our audience, your real estate agent or broker.
Wow, so if I represented a client in buying their investment property 2 years ago, I cannot act as their 1031 exchange facilitator now. I'm disqualified.
That is correct, according to Pub 544. Knowing this prevents you from accidentally stepping into a role that could disqualify the entire exchange for your client. Huge potential liability there.
That's a crucial nugget right there. Good to know. What about sales between family members or business partners? Are there special rules?
Yes. Pub 544 and 551 address sales and exchanges between related persons. Special rules apply here. If you sell depreciable property, like a rental, to a related person and realize a gain, that gain is automatically treated as ordinary income regardless of how long you held it.
Ordinary income, not capital gains.
Ouch. Right. Related persons for this rule include your spouse, siblings, parents, children, and certain entities where you own more than 50%, and losses.
What about losses?
Losses on sales between related persons are generally not deductible at all. Pub 544 notes a limited exception where the buyer, the related person, might be able to use the disallowed loss to offset any gain they have when they later sell the property to someone unrelated.
Complicated.
Very. Again, recognizing a client is selling to a related party is a major signal they need tax advice.
Are there any other less common tax scenarios an agent might encounter? Just briefly.
Sure. Pub 544 mentions involuntary conversions, where gain might be postponed if property is destroyed or condemned and replacement property is acquired. Pub 523 also notes that income received from selling personal property, like furniture included in a home sale, or money received for an option to purchase that expires unexercised, must be reported as ordinary income. And sometimes for a given mortgage debt can be taxable income, although there were specific exclusions for certain situations under prior law.
Okay, that's a lot of tax ground. But how does an agent practically apply this without giving tax advice, which we absolutely shouldn't do?
This circles back to our Adapt and Connect theme. Your role isn't to calculate taxes or recommend strategies, but by understanding these core concepts, basis, adjusted basis, capital gains, short versus long-term, the rates, and recognizing situations like partial business use, 1091 exchanges, or sales to related persons, you become invaluable.
Elsa.
You can proactively identify when your client's transaction has potential tax implications that deviate from a simple home sale. You can explain why they absolutely must consult a qualified tax professional, a CPA, or enrolled agent before closing.
So it's about spotting the complexity and making the correct referral. Knowing when to say, talk to your tax advisor.
Exactly. Knowing these rules allows you to flag potential issues early in the transaction timeline, manage client expectations, and ensure they get expert advice on something that could significantly impact their financial outcome. It demonstrates a higher level of competence and trust.
Right.
It positions you as a truly valuable resource who cares about their overall well-being, not just getting the deal closed.
That feels like a much higher level of service than just opening doors.
It is. It builds your expertise and capacity to adapt to diverse client situations.
Wow, we've covered a tremendous amount of vital ground today, from the nuts and bolts of signing a deed to the complex tax rules that can trip up unsuspecting clients. Really dense stuff.
We really have. To pull it all together and recap the essential knowledge nuggets, we dove into deeds. We talked about them being the legal instrument of transfer.
Right, the proof.
Exploring the key differences between grant deeds with their implied covenants and quitclaim deeds that offer no warranties. We detailed the practical steps of filling out and recording a deed required info, forms of title in California, PCOR recording, plus that fascinating CA corner on the after-acquired title doctrine.
Then we moved to title insurance, the essential protection looking backwards against hidden historical defects. We explained why it's crucial for securing an investment, the different policy types, the importance of the preliminary title report,
Prelim, yeah.
and clarifying that while the lender's policy is required, the owner's policy, though not legally mandatory in California, is highly recommended in other CA corner.
And we thoroughly explored escrow, the neutral third-party process conductor. We detailed the escrow officer's impartial role, the key differences between licensed and controlled escrow companies in California, and why checking their status is vital, hitting our CA corner again.
Right, the due diligence.
We walked through the step-by-step process from initiation to closing and identified common reasons for delays, particularly those financing issues.
Finally, we connected all this knowledge to real-world practice in our Think Like an Agent segment. We applied it to scenarios involving disclosure obligations and the ethical compass, navigating title issues, managing client expectations during escrow, and guiding clients on complex details like forms of title. And we rounded it out with Adapt and Connect, highlighting the importance for agents to understand core financial and tax concepts, basis, capital gains, recognizing special situations like partial business use, 1031s, related party sales so they can appropriately advise clients to seek professional tax counsel.
Mastering these components is absolutely foundational for any California real estate professional dedicated to building a career on integrity, trust, and competent service. You just have to know this stuff.
Absolutely. It's about being the confident guide your clients need during one of the most significant financial events of their lives. Speaking of guidance, that brings us to our next steps. Armed with this deep understanding of the legal handover, join us for our next deep dive, where we'll explore. Well, we'll keep building your expertise on your quest to become a top California agent. Stay tuned for that topic.
Knowledge applied ethically is the path to success. It really is.
So take some time with this material. Review your notes, re-listen to sections if needed, practice explaining these concepts in simple terms, maybe to a friend or colleague.
Yeah, that's a great way to learn it.
Consult with experienced mentors or brokers in your office. Don't hesitate to dig deeper into the specific forms or legal codes mentioned as they arise in your practice.
Continuously deepening your understanding in these core areas will enable you to adapt to diverse client needs and market challenges, building a strong ethical career in California real estate.
Thank you for joining us for this deep dive. We trust you feel more informed and confident about the crucial legal handover process in California real estate transactions.
Yeah.
If you found this valuable, please subscribe or follow the deep dive wherever you get your podcasts.
Please do.
And share it with others who are on their learning journey in California real estate.
Until next time, keep learning and keep diving deep.